In 2024, Goldman Sachs made over $53 billion in revenue. Most people assume that money came from trading stocks. It didn't. Less than half of it did. The biggest, steadiest, most boring-sounding chunk came from things like advising on mergers and managing rich people's money. And that single fact explains almost everything about how investment banks actually make their fortune. If you've ever pictured an investment bank as a room full of guys in suits yelling, "Buy, buy, buy," while staring at red and green screens, that's the Hollywood version. It exists, but it's not where the real money is. That idea comes straight from movies like The Wolf of Wall Street and The Big Short. Exciting stories, misleading picture. Welcome to Martic Finance, where we explain investing concepts in a simple way. But first of all, a quick disclaimer. This is not financial advice. Investment banks barely trade with their own money anymore. After the 2008 crisis, regulators cracked down hard on banks making big speculative bets, especially in the US with something called the Volcker Rule. Today, when an investment bank trades, it's almost always on behalf of a client, a pension fund, a corporation, an asset manager, not betting its own cash on where the market goes next. So if it's not gambling, what is it? 4 real engines drive the money, and we'll go through them because each one works completely differently. Engine number 1, M&A advisory. This is the classic investment banker job. When one company buys another, a bank gets hired to manage the whole process, valuing the target, negotiating terms, structuring the deal so it doesn't blow up from a tax or legal standpoint, and holding the client's hand through months of tense back and forth. Here's what surprises people. The fee isn't flat. It's a percentage of the deal size, and the percentage shrinks as the deal gets bigger. For a small deal under $10 million, advisors might charge 5 to 10%. For billion-dollar-plus mega deals, that drops to roughly 0.5 to 1.5%. Sounds tiny, but it isn't. 1% of $1 billion is $10 million. For advising on a single deal over a few months, and the bank often doesn't stop there. If the buyer needs to borrow money to fund the purchase, the same bank usually arranges that financing too and earns a separate fee for it. This is also a winner-keeps-winning business. Once a bank has advised a company on one major deal, it usually gets the call for the next one. That's why the same handful of names show up again and again on the biggest deals in the world. Goldman ranked number 1 globally in announced and completed mergers and acquisitions in 2025. Decades of trust built one deal at a time. Engine number 2, underwriting. This is what happens when a company wants to raise money, either by selling stock to the public for the first time, called an IPO, or by issuing bonds to borrow from investors. Here's the part most people don't realize. When a company goes public, the bank often doesn't just help sell the shares. It actually buys them from the company first, at an agreed price, then resells them to investors. If the resale goes well, the bank profits off the spread. If it goes badly, the bank can get stuck holding shares nobody wants. That's real risk on its own balance sheet, not just advice on a slide deck. For taking on that risk and doing the work, banks typically earn 3 to 7% of the amount raised for an IPO, and usually under 2% for bond issuances, since bonds are considered safer and more standardized. Look at what just happened with SpaceX. On June 12, 2026, it went public on the Nasdaq at $135 a share, raising around $75 billion, the largest IPO in history, valuing the company at roughly $1.75 trillion. 10 banks shared the underwriting job, led by Goldman Sachs and Morgan Stanley, with names like JP Morgan, Citigroup, Barclays, and UBS rounding out the syndicate. Engine number 3, trading and market making. Modern investment banks mostly aren't betting their own money on whether stocks go up or down. What they're doing is called market making. Think of it like a currency exchange booth at an airport. You're not predicting whether the dollar rises tomorrow. You're just always ready to buy or sell, and you profit from the small gap between the buying price and the selling price, repeated thousands of times a day. When a pension fund needs to sell $500 million of stock without crashing the price, it calls a bank, and the bank's trading desk handles it, profiting from that tiny spread and the fees attached, not from a directional bet. This is a volume business, small margin, enormous scale. At Goldman Sachs, the division covering trading, market making, and investment banking fees combined generated almost $35 billion in 2024, with record results specifically in equities. Engine number 4. Asset and wealth management. The least flashy and arguably the smartest model of the four because it's recurring. When a bank manages money for wealthy individuals, pension funds, or institutions, it typically charges an annual fee, usually 0.5 to 1% of total assets, every year, regardless of whether the market goes up or down. That matters enormously. M&A fees are one-time events. The deal closes, the bank gets paid, then has to go find the next deal. Wealth management fees show up year after year, like a subscription. Goldman's Asset and Wealth Management division alone brought in over $16 billion in 2024, managing assets that had grown to over $3 trillion. Now let's make this concrete, because billions stops meaning anything after a while. Imagine a company gets acquired for $10 billion. The advising bank might charge around 0.75%, right in that typical range for a mega deal. That's $75 million for one transaction, often wrapped up within 6 to 12 months. The median annual salary in the United States is roughly $60,000. That single deal fee equals more than 1,200 years of an average person's salary, earned by a team of maybe 20 to 40 bankers. And that's often just one fee, if the bank is also arranging the financing. This is why outsiders assume bankers are simply overpaid for doing paperwork. But the real reason this business generates fees at that scale is what we're about to get into, because almost nobody else on earth can actually do this job. The first is relationships. CEOs and CFOs don't hire a random bank off a search for a $10 billion deal. They call the banker who's known their company for 15 years, who they trust to keep their secrets during sensitive negotiations. The second is distribution. When a company wants to sell $2 billion of new stock, someone has to actually find buyers willing to write enormous checks, fast. Big banks have direct relationships with thousands of institutional investors. The third is balance sheet. Remember underwriting? Sometimes the bank has to buy the shares first with its own money before reselling them. That requires tens of billions of dollars in capital sitting around, ready to absorb risk. And the fourth, hardest to quantify, is trust. When a company is about to make the biggest financial decision in its history, it wants an advisor with a track record of confidentiality and competence, not the lowest bidder. That trust is built deal by deal, and a single leak or botched IPO can destroy it overnight. Put those four together: relationships, distribution, balance sheet, and trust, and you get a business that's almost impossible to disrupt with a clever app or a smaller fee. That's the real moat. Now, here's a mix-up I see constantly, and untangling it changes how you think about the whole financial industry. People throw around investment bank, hedge fund, and commercial bank like they're the same thing. They're not even close. A commercial bank is the one near your house. It takes your deposits, pays a little interest, and lends that money out as mortgages and car loans. Think Bank of America or Chase in their retail role. A hedge fund is a private investment firm that takes money from wealthy investors and institutions and tries to generate returns by actively betting on markets, closer to the gambling image people have, though even that's an oversimplification. An investment bank does neither as its core business. It's a facilitator for deals, fundraising, trading flow, and managing institutional and wealthy clients' money. Some firms, like JP Morgan, blend a commercial bank and an investment bank under one roof, which adds to the confusion. But the activities are fundamentally different businesses, with different risks. This distinction matters because when people criticize the banks for reckless gambling, they're often describing hedge fund behavior, or pre-2008 trading practices that don't really exist in the same form anymore. And that's all for today. If you found the video helpful, don't forget to like and subscribe to continue growing this community. Thank you so much for watching, and I'll see you in the next one. Bye.